Charlie Meadon, CEO of Eccuity. How are you?
Doing good. Good to be here. We've been talking about this for a while and the different topics we're going to hit today. So I'm excited to jump into macro, MicroStrategy, general investing. Yeah, I'm excited.
Let's see where it goes. I was watching this thing that came up on my feed, which was the first 2 hours of MTV, released in 1981, and this launch of this new thing, this stereo music with video that was like mind-blowing back then. And it got me thinking just about my childhood growing up in the 80s and all the other things that were memes or fads.
Right.
Like, what is that, and where do we see that in the investing world?
So mimetic behavior is the one person does something, so another person copies, and then it's like a viral effect where nodes connect to other nodes, and you basically get reinforced behavior that feeds on itself. And George Soros calls it reflexivity. Again, behavior that reinforces a behavior and a belief. And that's where the meme comes in. So a meme is like a picture, right? And it has a feeling that culture resonates with, and people resonate with, and then it gets shared. So mimetic behavior, in the kind of internet realm is a meme. And what you get is a picture that resonates with a bunch of people, they share it, and then it becomes a thing.
Like that Coldplay image.
Yeah.
That's probably still fresh in our minds, right?
Totally.
Yeah.
Yeah. We've seen, time and time again, behavior politically, all sorts of things where this reinforcing behavior kicks in. And then you get an extreme, and then you typically get a reversal, because they're often in markets. So this is kind of shifting to markets where mimetic behavior or reflexive cycles can be described, where the expectation gets eventually divorced from reality.
And I guess George Soros, interesting guy, he would understand reflexivity, not just in the investment world, but in the other areas that he exerts influence in. And he probably exercises a portfolio approach to his mimetic or reflexive strategies that he deploys as it relates to investing, though. Normally, by the time we kind of the picture gets to us, it's probably late in the cycle, right? Depending on how alert you are. And most people will be on the other side of that trade, right? Or on the other side of the hill when it comes crashing down.
It's hard, because when do you pick that point? And, what we've seen in markets in recent years is when you get a reversal of that reflexive behavior, it springs back pretty quick. So, it's very hard to know, obviously, when you're in a mania, when there are some kind of fundamental dynamics that are pushing a mimetic trend. Howard Marks is quite good, where he has the piece around, it's not necessarily about how good the asset is as well. It's also what you pay. What you pay is important. You don't want to be in a situation like Japan, where you basically have a 30-year trough of kind of like despair.
Mm-hmm. Looking this to the Bitcoin, then. So I think a lot of people, maybe when they first became aware of that, probably would have written that off as some sort of meme, right? Some sort of mimetic trade. Would that be fair to say?
Yeah. I mean, the whole thing is actually like a very strong demonstration of mimetic behavior in a belief system. Because ultimately, Bitcoin is a belief system of the technology and the decentralized. It is ultimately a belief system, and that's why it's gaining value, because more people are believing it, therefore allocating capital to it. And I think what you have to go back to is that initial thesis, right? What's the thesis that's driving the mimetic behavior? It's the idea that we shouldn't trust centralized institutions, ultimately. And then what's happened is you've had an extended track record of people losing faith and belief in traditional financial systems, mixed with the influence of technology and technologists. It's actually a natural evolution, right? It's like, look back 50, 60 years, banking, right? Banking, even beyond that, banking has been the area of primary influence, because before you had technology, the best way you could leverage was through financial instruments. Now computation and the cloud is the best, highest leverage arena. Banking's got a lot of influence. technology starts to gain a lot of influence and use its leverage in the cloud, in computation, which leads to more revenue, more influence, more people buying into their equities, that grows their value, which has now led to them potentially starting to eat the banking system.
This digital trend is almost like a byproduct, isn't it? Like a lot of the thinking, the tech bros, the libertarians, starting to infuse their bits. It's almost creating a narrative, which is creating a meme within it, right?
Yeah, Rockefeller to Musk.
Rockefeller to Musk.
But it also is serving purposes for people. I mean, there's a reason people are buying into it, right? People realizing cracks in the system and then reinforce behavior that they're right, that's being permeated to the market.
Once you start to see things a certain way, you start to see behaviors that reinforce that line of thinking. And then as that spreads like a virus, that way of thinking, it creates that reality as it spreads throughout the system.
It's the worst way to invest, right, is to extrapolate in a way future that's going to be the same or as powerful in terms of the trajectory. But the problem with extrapolation is that you're prone to over or underestimate. And, we often believe that in the short term, we overestimate and in the long term, we underestimate. And I think that's kind of Bitcoin totally is a representation of that, right?
Yeah. And recently, I'm going to read out a few of these quotes because I think it kind of speaks to exactly what we're talking about here, right? Ray Dalio, this is a real recent one. This is what he says. If you were neutral on everything and optimizing your portfolio for the best return to risk ratio, you would have about 15% of your money in gold or Bitcoin. He goes on to say that he prefers gold, but he cites the risk of fiat currency debasement. Then you have Larry Fink, same sort of thing. He's saying a 2 to 5%. He says Bitcoin is like a hedge against global economic political instability, describing it as an international instrument for mitigating currency or fiat debasement. Paul Tudor Jones, same sort of thing. He cites government debt issues, guarding against inflation. Stanley Druckenmiller, currency debasement. Cathie Wood, same sort of thing. So we got these fairly influential people that are all kind of talking to the same thing, which is this theme of currency debasement, which creates, we're seeing it through inflation, but what it is too much currency creation going on for the amount of goods and services available to buy. And as these influential people are saying that, they're reinforcing this message, and that the natural outcome is, gold and Bitcoin. That seems to be the two hedges that one could use to protect that. So is it really fair to say that this is a meme, or is this really the future? Like, is it
100% the me? Everything is the me, right? So yes, but anything is a meme. Any kind of event where people kind of discuss and take sides on something, it is mimetic in nature.
But it could also be permanent as well, right? It could also signal the beginning of something new.
Yes, I mean, really, the meme may be a moment in time in that asset's history, but obviously the asset lives on.
Sure.
So I'm definitely not advocating for either side of that, bullish or bearish Bitcoin. What I would say is that my view on Bitcoin is that it makes sense that this is happening, and there's the reason why people are speculating on gold and Bitcoin, because they are concerned about their dollars or how much their dollars are actually worth and the inflation that's happening. The general meme is uncertain.
Do you see that going away then? The uncertainty?
No, it's always uncertain. I think we just
are we just more aware of it?
We're more aware of it, and now you have the internet, so you have to permeate that. Things permeate quicker. Like, you can move money out of the financial system quick now, right? Things to move fast. Not like the old days where you go queue up at the bank and they could lock the door or be extra slow to stop the bleeding. They can't do that. So that's why you see a bit of a use case for Bitcoin in that case too, and self-custodianship of assets.
So I've been saying that it comes with the faster ability to buy and sell.
But I think that's the main threat here, is that, the velocity of capital and the velocity of the transfer of assets is going to keep increasing, because that's where we're going. That's where the market's going. That's where the most influential businesses are trying to go. because the casinos are ultimately be open all the time.
That's right.
So as an investor trying to be prudent and have a strategy around your capital allocation, you can't get swept up in the emotions and the memes of the day-to-day kind of ebbs and flows of markets. You need to have a strong strategy and not play the game, because the market currently is moving towards, we will let you trade more and more and more and more. And that's not a sustainable way to live life.
So you're driving faster down the highway, right?
Yeah.
Smaller inputs have a significant movement. Therefore, you have to be really carefully moving around, because if you're looking at the short term, the increased frequency of capital flows means that you can probably get caught on the wrong side of it.
And then you get into a decision tree where you're forced to continuously make decisions. And then before you know it, 2 weeks has passed and you've made 30, 40 decisions that you probably shouldn't have made.
Right. But we're moving potentially to 24/7.
Yeah. 24/7 trading seems to be a thing that's going to happen.
Yeah.
That's definitely made me think about how I allocate capital, for sure.
Right.
For sure.
Okay, and in what way?
You actually just have to be high conviction and just accept that the volatility is a price that's going to increase. And then, if you're really trying to monetize something, I would say I'm going to look to monetize the volatility itself. So don't interrupt compounding, have a very solid base of productive assets. But, if I was to go and kind of be a trader, right, I would say I'm going to go in there and I'm going to try and monetize volatility.
What's interesting about what you're saying there is that, and for those that are listening or watching, that these concepts are kind of new. Just think of it as that energy is released when things shake, and you can harvest that energy and convert that into a gain, right? So there are strategies that could be deployed where you could actually engage in something sophisticated like a delta neutral hedge, where you're collecting both sides of that movement. Obviously, it's pretty sophisticated, but when you start getting into these more sophisticated trades, and then when you understand how companies like Strategy are harvesting the Bitcoin volatility, then it starts to kind of make a little bit of sense. So let's just start at a really, really high level then. For those that might not know, because I'm coming across people from all sorts of different backgrounds at the moment, and I won't say I'm surprised, because it is kind of a niche area still. What is MicroStrategy, now called Strategy? I know there's software, but give us the color there.
Well, MicroStrategy is fundamentally a software business that provides BI software to enterprise clients. They had a huge run up in the .com bubble, and they gave all of that back and kind of stayed kind of alive, but just kind of plodded along. Investors weren't too interested, but they were public. So I think that sets the scene. So being public allows you the opportunity, other than, your average small to medium business or, your cafe up the street. They don't get access to the same deals in the financial market as a public company. If you're a public company, you get the cheapest cost of capital possible, usually, versus, a startup, very expensive. A small to medium enterprise, very expensive. Personal loans, very expensive, right? That's the first advantage they had. So they were public, which allowed them to be more innovative on how they raise capital. Right. Fast forward to when Michael Saylor becomes bullish on Bitcoin, because he recognized that basically currency was being debased. He said, okay, well, how do I take advantage of this constant debasement of currency? Oh, well, I buy Bitcoin, and this made it clear, he is going to find any way he can to accumulate more Bitcoin. And he believed that is going to provide him the best return.
Okay, so let me pause you and just make sure that everyone's up to speed here. So he caught onto this narrative quite early on, like what we were talking about before. Right? Like he just realized it sooner. I think a lot of individual holders of Bitcoin have their own revelation of this. The lights come on and the penny drops, and they go, okay, wow. Fiat currency is infinite. It has to scale up infinitely. It's on an exponential curve. So anything that is finite will actually rise in value if you denominate it in that infinite currency. So he had that realization. Melting ice cube, I think was his phrase. All this cash that MicroStrategy had that wasn't getting a return, why not just put that sum into Bitcoin, or put some of that into Bitcoin, and then, take it from there.
They have taken on a lot of debt to buy Bitcoin, and they've now introduced different classes of shares which almost act as like bonds that they can just continuously dilute the shareholders, which also dilutes himself, but he still has the voting rights to keep going. And the reason that they're doing this is because he believes that that debt is going to be worth less anyway because it's denominated in US dollars. So he's borrowing something that is becoming worth less, and is accumulating something that he believes will be worth more because that currency will be worth less.
Which I think is really important, just to draw a parallel between that and, say, the mechanics of how it works when you're buying an investment property. It's the same thing, right? You're borrowing something which you believe will become worth less, which is dollars. So you're borrowing those dollars, translating into a relatively scarce finite asset, which is property. And because you have a belief it'll be worth more, denominated in a thing that will be worth less. Exactly the same sort of concept, isn't it?
Yes.
And it works until it
So it does.
It does.
Leverage cuts both ways.
Yeah.
So it improves your gains when it's going well, but then there are consequences for if it starts to go wrong, and it creates reflexive downward spirals. Because if your net asset value of your Bitcoin goes down to a certain point, the people that have borrowed money may ask you to put up more collateral. The whole risk in the MicroStrategy piece is obviously liquidation risk, and it will come from two areas: net asset value going down, and then basically you getting margin called. So they're like, "Hey, you don't have enough asset value to have this much debt."
Sure. And I guess the other thing is that if the debt that he's issuing becomes sophisticated in the way that he can pause the payments going out, convert it to equity, that helps as well, doesn't it?
So now if we get into that piece. So I think one thing a lot of people thought was interesting is he got a convertible note but didn't pay interest.
Yeah, we're breaking down what that means.
Yeah. So it's a way that when you don't know the value of something, it's a good way to kick the can down the road before it converts. So a lot of startups, when you don't know the value, is it worth zero? Is it worth $1 billion? Who knows, right? Someone lends you money, in the future it converts as equity. You go, well, how is someone lending this dude money at 0% interest? That's I think so that everyone should be asking themselves, right? How is that possible? Well, it's because of hedge funds and basically the public markets, but I'll get to that last. I think that's the best. But so then there's this thing called Strike, and that's been created, which is a different kind of share class to MSTR, which most people own. And then you've got Stride, which is a dividend paying kind of bond in the form of a share thing. And it has better preference over MicroStrategies in a sense.
So everything goes back. You're going to get your money back before
the common shareholders, which is the MSTR. Sure. So it goes, Stride has the most protection because it's really just a 10% yielding bond, in essence, with a conversion preference, which means that the business goes bad, you're ahead of the queue of the people that own the underlying equity, which is MicroStrategies or MSTR. And then you've got Strike, which is basically a leverage play on the equity because it's paying you a dividend, but it's also giving you an out-of-the-money call option. So if MicroStrategies, let's say, doubles, then you're then going to, that out-of-the-money call option will be in the money.
So that'd be a great way to say, right, well, I want to make sure I'm getting some return for this money I'm lending out. Worst case scenario, but I want to participate in some of that explosive move upwards should that occur, right?
Yeah. Now, the interesting piece around all of this is that Michael Saylor can basically choose to just continuously dilute the shareholding, which actually reduces the value of the company for the people that own it. So the whole piece here is it then becomes a belief system and mimetic, right? So that's where the risk comes in. So there's some reflexive ways in which it can go bad, where Bitcoin price goes down, they essentially get margin called, and then lenders get all their money first, which are the people that lent them $8 billion. Then your Strides, then your MSTR, I believe, then your Strikes, most likely, I think. And it could be the other way around between Strike and MSTR. There's too much information to actually.
But it's like where I get quite interested in this is when we think about zooming way out and we think about the last 40 to 50 years, around how bonds have been great only in the environment where interest rates have been getting lower and lower and lower. It's just the 60-40 portfolio or the 80-20 growth portfolio starts to kind of look like more risky, including the bonds, than less risky, including the bonds. So do you think that some of these products will find their way into a lot of everyday portfolios in their bond allocation?
I don't think that that's going to happen imminently from a self-directed perspective, maybe in more advanced family office settings and kind of private capital that's trying to be sophisticated.
Yeah.
I think it will continue to be more adopted there. But the great thing is, if someone is curious, is obviously the market is allowing for more and more creativity when it comes to asset allocation. I think like the big risk with what they're doing, like I think I like the thesis. I like the thesis of, you've got a debasing currency, and what you're saying is you're holding on to assets that are either productive or scarce, therefore are going to be worth more in the future and going to save me from that debasement. But what they've created is they've created a tail risk, which is that things go wrong even for a short period of time and everyone loses their money, right? So they've created a potential death event. So I would personally never invest in a business where there is a tail risk present in the business model or in the balance sheet that could result in them being liquidated. So why I avoid banks, I avoid a bunch of financial companies and healthcare companies where you're just looking at kind of a trial that has a death risk, right?
This proper risk or permanent loss of capital. Not just call this.
That's right.
Yeah.
Although I'm happy to trade volatility and trade derivatives that can have permanent loss of capital.
Yeah.
But it's different.
Sure. So take me through that. So how would, say, hedge funds or...
Yes, let's now talk about that, right?
Yeah.
That's interesting. What's happening is why, the question is, why would someone loan someone, basically participate in a convertible loan where they're not getting paid interest? Well, you could say, well, they are getting paid interest. Because what they're doing is, I'm going to you, and I'm going, you're MicroStrategy, and I'm going, I'm going to lend you a bunch of money, and it's going to be connected to an option of your stock. So I can one day get your stock somehow. And I'm actually going to give it to you for free. And what I've gone and done there is I've basically entered into that position. Now I can go to the public market where retail investors and professional investors are speculating over the price of Bitcoin and MicroStrategies, and I can sell them the options in the public market at a massive premium. So for as long as you've got that, for as long as there's a mimetic trend and people are speculating what's going up and down, there's basically a market for derivatives, which means those hedge funds and those other institutions can go and lend you money, because as long as the casino is still full, they're getting paid a massive premium on their hedge, because they're basically hedging their position out by lending the money to MicroStrategies in a way. And then they go into, a random retailer that's speculating on their earnings that are today. I wonder what the price of move is post earnings. That's quite interesting. But, that hedge fund has got written an option to allow others to speculate. They gain that premium. So they get paid to do that. It's while having protection by writing the original loan, essentially, to MicroStrategies.
Right. So they make money if it stays still. They make money if it goes up. They make money if it goes down.
And in the case that it all blows up, they're the first people to get paid.
And ultimately, it's coming from somewhere, right? So it's coming from people who are speculating only on one side of it, right?
Yeah, so its average price move on MicroStrategy is down about 5%, whereas the S&P 500 is 0.6.
Got it.
So you're getting almost tax volatility embedded into the daily price move.
Right. Is this going to become more mainstream, like investment strategies that look like this? Because normally, I'm just thinking about traditional investing where you'd allocate across asset classes and jurisdictions, and you buy old, it's long term, and that maybe there's a small amount that you might put towards higher risk speculative bets. But do you think that this sort of thing will become a lot more mainstream as time goes on?
Yeah. For example, we're just about to release our equity lending program where you can basically have your shares up to be lent out to people that are short selling, which gives you a further yield on the long-term buy and holds that you have. So if you are owning 20 equities, right, and you're not going to sell them, you're just holding them for the long term. So similar to what kind of MicroStrategy is doing in a way is you're saying, hey, market or people in the market that want to speculate and short sell, then you can borrow my shares and you're going to pay me 3.5% a year. So there are ways you can basically, as more and more products become available, there are ways you can participate in it without necessarily being the one that's actually doing the gambling. You could, for example, two very common and easy to implement strategies that a lot of people in America use is the stock lending programs where you can get an extra yield. It's like getting a dividend on all the stocks you own, even if they're not dividend paying. And then the second one is covered calls. So actually writing options on the positions you already own and getting a further premium on that. Now, the risk there is that you lose the asset because it reaches that price and you have to give it up. But those are kind of two quite common applications that Americans use quite regularly. The market here is not so sophisticated, but with technology and the rails being made available, it's actually something that's quite simple to implement and execute.
I guess as things get a little less easy or as it becomes a little bit less easy to get a return through low risk activities, I guess this becomes a lot more normal, right?
But most importantly, I think what Mike was saying is kind of on the right track, but I don't know if it's going to work. And it's what Buffett worked out was, how do I keep the asset? Right. And we see this time and time again in New Zealand of selling the asset too soon, losing the asset. And then, because remember, as soon as you lose, let's say I sell Eccuity tomorrow.
This is your business. Yeah.
The day after I sell it, I get that trash into my bank. I'm now losing. I now have to do something.
With inflation, right? You're not putting it at risk. You're losing the value.
Whereas as long as I'm in Eccuity, as long as I keep improving the productivity of Eccuity and keep growing, I've got a valuable asset that is productive, and I don't have to worry about debasement of currency because I've got the asset that is irrelevant to currency. Because if we start trading in shells or Bitcoin, I'm good. I've got the productive asset. So I think what the movement needs to be is like owning productive and scarce assets. That seems to be the trade, and it seems to be what's working in the market. If you look at Bitcoin, you look at gold, you look at the S&P 500.
So when you say productive assets, so obviously gold and Bitcoin would not be productive.
Yes.
They're scarce assets. So productive assets would be, it could still be technology.
Yeah, but it's a business that creates a product or service that generates ultimately free cash flow.
Right. So that's why you
could, in a sense, be a rental of property as well, because you go, well, it's not really a productive asset. It's not that productive. It's not going to take its growth from 5% yield to 20% in light yield.
Yeah.
On the rent, right?
Yeah.
But a company can grow, like Nvidia can grow, all of a sudden grow their earnings by 60-70%.
Yeah.
And so it's got a similar character. It's like almost like a hybrid, isn't it? Assuming that people want to pay more for the property price, or if the property price value, what currency it's in, if the currency is getting less valuable, then actually the absolute value of that asset might be worse, which we've been seeing for the last couple of years. Is it?
Okay, so we're touching a little bit on the edges of property now, and I want to come back to that in a second. But before we do, let's talk a little bit about the Fed funds rate. I think that was
today.
Yeah, it's today, right? And no change, correct? Yeah. No change. We have this a little bit of an interesting dynamic happening with Trump and Powell.
Yeah.
In that Trump clearly looks like he would like to get rid of Powell. The U.S. Federal Reserve doing a massive renovation.
Yeah.
Kind of almost feels like a lot of those stories are being kind of released almost as justification to create a path.
He's trying to bully him out, right? And I don't think he's going to budge.
Yeah, I think so.
No, he's not budging. He has gone in to do a job, and he cares about the fundamentals, and he has a view. And his view is that inflation is not done and taken care of, and the economy is not slow enough for them to justify lowering rates. However, the country has a debt problem, and that's what they're trying to solve. And Powell is getting in the way of that But if power doesn't get in the way of that, then may have other consequences.
So the strategy, like the monetary strategy versus the fiscal strategy, plus the statecraft and all the other stuff around the edges, but sometimes they work in tandem and sometimes they don't, right? And that's that whole independence piece, which is kind of getting in the way, but it depends on who's in charge of the.
I mean, we had this conversation on the phone, right? You were like, hey, I actually do think we should lower rates. And I'm like, yeah, but that's for you on Bitcoin. Yeah. Right? And it's like the conflict is the asset owners will benefit and it will help them because they hold a lot of debt and they're struggling, right? Governments and businesses and people that are asset owners are also heavily indebted typically, right? On a global level, especially governments. So they need to get their payments down. So they need interest rates to lower so that they can continuously pay their debt.
Mm.
The problem is if you're not an asset owner and you are a consumer predominantly and you are living paycheck to paycheck, you are losing the most out of this. So if we lower interest rates to help these wealthy people and these indebted, irresponsible governments, then we're not actually solving the problem and we're making it way harder for people that are already having potential risks around displacement of employment and earning.
How much of that, though, do you think is decisions that require a smart move? Like, how much of it is actually possible to be executed perfectly versus systemically the whole system is just completely retarded? Like, it's a mess. It's beyond the realms of something that you can salvage, and it's systemically breaking down.
Yeah, so it's an incredibly complex system, and I nor anyone else on this planet have an answer. And what we're trying to do is we're trying to balance multiple risks, and it's a seesaw. So in some like there's a way, right, that you go forward and you try to just make small, incremental, good, rational decisions. Sometimes that good, rational decision is waiting. So in terms of the Fed choosing not to lower rates, is their ways to say, give me a little bit more data. Because right now the inflation is now starting to trend up here and in the US. So there is rationale, and where's the low employment numbers? Not there. Where's the demonstration of less government spending? Not there.
Yeah, and in the US with the Doge initiative, obviously that didn't yield the types of result. That was kind of like a Hail Mary, wasn't it? Like there was no way that it was.
It was the way to win the election.
So now that that's kind of done its dash, is it inevitable then that is it inevitable that they will spark off inflation? Because ultimately the system will protect the system, irrespective of whether it's the rich against the poor, the government against the people, whoever it's side.
And I don't think I think we just have to accept the system. This system is so complex that I don't think there is not overarching them versus us situation.
I totally agree.
There's just a very big system that's hard to manage. And the best thing we can do is endow ourselves with as much knowledge as possible and a good group of collaborators to try and actually have good outcomes for ourselves, our families, and our surrounding influence, right?
So how much of the strategic Bitcoin reserve would you put phase in as another way, kind of like, I guess in a way, going back to what we were talking about with Michael Saylor through strategy, what they're doing with their Bitcoin strategy, I guess in a way the U.S. government could do, and that's kind of been floated as the idea. Whether they'll execute it on that and whether they'll do that well is another story. But if they did, do you think that could actually save them from the debt situation so that they could actually deal with higher rates and currency debasement through inflation, continue to walk that tight line, right? They'll still create all those problems, but this asset now goes to infinity and maybe it solves the debt problem. Do you see a solution there?
No, I actually don't see it reversing. So as much as it makes me feel like we're in a irresponsible, frothy bubble, I don't really know. I don't know what makes it reverse. Because if you think about it as well with AI and automation, what the market is also saying with like the stock market performance and the outperformance of a lot of people's Kiwi savers, because they're very exposed to US companies, specifically big tech, is that, what the market's voting is saying that more of the capital generated through services and products is going to go to the company because they're going to have less employees and they're going to have more computation. So that's happening, which creates the whole kind of Bitcoin conversation, right? Like that's really kind of a tailwind. On a headwind is a tailwind towards, I wrote a memo in end of 2021 when I started to see the inflation pop up and driven by basically increase in money supply and just irresponsible kind of printing of money, right? Was how do you fight inflation in a deflationary world? And that's where we're at. Kind of time is becoming worth less, or you can generate that through tokens. And tokens are intelligence. So an LLM is generating intelligence for every token that it churns out, right? And a business could implement ways in which it uses artificial intelligence and agents and different automations to take care of business processes. So that is very deflationary, which means that asset prices could, in theory, become more expensive. Because of this deflationary nature in an inflationary world, where you've got supply chain issues, where you've got debasement of currency, where you've got unsustainable debt levels. Shit's that complex system, isn't it? It's hard. So that's why, being relatively concentrated in assets that you get a good sense of understanding and have confidence they're going to be around to survive, then that seems to be a pretty rational way to approaching it. But what you can't do is you can't expect to get these astronomical returns in a linear fashion forever. Markets don't really return. They're not in equilibrium and they don't return to an equilibrium. It's just that there's information and perceived price at any given time, and that can drastically change. And just because it's gone above doesn't mean it's going to revert to mean. And just because it drops a lot doesn't mean it's going to revert to mean. So there's no guarantee you ever revert to an equilibrium in markets. I think people need to understand that. Look at Japan. But ultimately, you want to own productive things that are going to live on.
Good. So staying on that AI theme then, I know in my own business experience, it's been something where I've found probably, even just in the last 2 years, definitely we're on an exponential scale in terms of being able to replace labor to do menial tasks with more and more versions of technology, stuff that helps me to write better, organize my thoughts better, booking tools for my client meetings, a lot more automation with payments, stuff that people doing before. Yeah. And stuff that I had to put my own time into. But I think there's a lag with some people in terms of adopting these things. And even now I feel like I'm behind. And so do you feel like as an inflationary sponge, if there was more currency units being produced in New Zealand, for example, do you feel like the way that AI is working will soak up that potential inflation?
I think that currently the traditional economic system which we run under, GDP is heavily driven by kind of labor. So that shift is going to be unknown and potentially painful. So I think there is a teething process. But as a business owner and an operator, actually just someone that's trying to better them and their family's lives, etc., now's the time to think about having a strategy for how you're going to utilize this automation and AI into your life, but also into your business approaches to increase those asset values as well. Because a lot of business costs or a lot of business valuation is around, gets encumbered by key man risk, for example. So yeah, we're in a situation where, hey, we have these systems that allow us to execute tasks and strategies and keep us informed. Mm-hmm. We should utilize that.
Oh, totally. From an employment perspective, I think of all the jobs out there that are potentially just going to vanish. And in fact, they could already vanish. The reason why they haven't is probably because of friction associated with exiting employees that are no longer productive relative to the technology that can replace them so easily. If you were, say, in your mid-40s, for example,
you had an employee or some employees, you have to become an equity owner. You have to find a way to have skin in the game on an asset or a service. joining a startup very, very hard. So maybe you don't got to do that. You still like your 200K a year job, but you know that's at risk, right? Ultimately.
Yeah.
So you might be like, I'm going to still earn this great income. That's going to be my cash flow, my free cash flow. That's going to be a strong asset for my family. But I'm also going to build up these assets, this side gig, where I'm going to own a bit of equity in a YouTube channel or a little bit of equity in a startup where I can consult and do some sweat equity so I can earn 0.5% of the business for giving 3 years of my knowledge.
Yeah. That is really good advice for some people, but not everybody's going to do that.
Yeah.
And so I'm just kind of zooming out now and I'm thinking about, well, how does this play out in New Zealand where, like, let's be honest, at the best of times, we're not too fast with adopting new things, right? And so I guess my concern is that at an economy level, there will be a lot more unemployment coming, would be my base case, right? A lot more. And we're already in quite a subdued recessionary time, in my view. Boots on the ground, it looks and it feels very tough out there for everyday households. And if AI takes away income from these households, I'm just trying to think, well, why not? Why not front run that trend, which is exponential and inevitable? Why not front run that and make the cost of money cheaper right now? In 20th of August, 2025, we have another meeting from the Reserve Bank of New Zealand. They're going to be announcing the official cash rate again, the OCR. Currently, it's at 3.25%. My view, I'm going to go way out there and say that I'm not necessarily saying this is true, by the way, but I'm just saying this just to annoy you, if nothing else, Charlie. I think they should go 1% cheaper. Yeah, I think they should do a monster cut, make it 2.25%. Inject a huge amount of stimulus into the country. That's on the belief that we have momentum going on, like slowing momentum, which will be hard to reverse, partially exacerbated by employment disruption from AI. That's kind of my rationale. And yep, we could get a re-inflationary, but we are in that 1 to 3% band of inflation. And a lot of those inputs, well, they're coming from overseas factors, commodities, right? That we're inputting. It's coming from government spending, which, is the OCR really effective? Possibly not. So that's kind of why I would say, let's go for a monster cut. But I do acknowledge that it could reignite inflation. It could benefit asset owners and really just fully punish those that don't own assets. Your view, though, would be that interest rates need to stay high, though. Would that be fair?
What you're doing is you're taking an economy that was geared towards debt and speculating on house prices in order to get economic growth. So, for example, your house price goes up a lot. You're actually willing to borrow money against your property in order to fund your business and expand it. So you have a economy that's completely geared to a type of investment that is not ultimately as productive as, building a SaaS business and exporting it to the UK or Singapore, right? So what you've got an economy that's geared towards this kind of regime, and we need to work out a practical and intelligent way in which we change the allocation distribution and that dependence away from the current status quo towards something more sustainable for everyone in this country, right? So, and I also think, personally, we've seen a lot of people get into, the property game, and because they don't know anything else. So it's just the easy option. And I think it's not that goes away. Like, I'm actually all good with, rentals as a piece, and I'd probably own a rental, maybe even owning my own home. I see owning your family home as a lifestyle choice. Then obviously you got rental properties. I do think that house prices will go up as currency gets debased, but I don't really think it's great if you're unprofitable in that business endeavor for a long period of time, paying high interest rates to banks, with the end goal being hopefully someone pays a larger price to offset all that cost. So, if you're a fixed cash flow positive, it's a cash flow positive business, right? A rental property is in essence a business, and is it making money, or are we investing it, right? That's really and that's what everyone does, and that's where business growth has been stemmed for. Angel investing is much more popular in New Zealand when house prices are going up. because people can borrow against their property and speculate on business growth. So that's kind of the problem we're in. Is okay, you lower interest rates by 100 basis points, and you create this kind of spur of demand where you better hope that the US drops interest rates next month by 200 basis points.
Exactly.
And so what's happening is you get a net effect that is a loss compared to the main currency, which is the US dollar.
Mm-hmm.
So if, like, New Zealand and a bunch of other countries aggressively cut rates while the US is not cutting rates because that
wouldn't be good, would it?
Terrible.
The way I see it working is that the Reserve Bank of New Zealand won't listen to my advice. They never do. They won't listen to my advice. The economy will get darker and darker and darker. And some of what you're alluding to will probably happen in certain segments. People will learn to be productive again, right? Like they'll reallocate capital towards things that are actually genuinely producing value and wealth, which is a good thing. But I think most people won't be able to make that shift. And in aggregate, I can kind of see the economy getting darker and contracting more and more, which then necessitates a deeper cut.
Yeah, I mean, you can potentially eventually get there, but you kind of typically want to ultimately get rid of some of the weak hands, unfortunately, but it's a natural consequence. And then also you have the kind of just the dynamic where, more and more people will actually find New Zealand attractive. And there are reasons why New Zealand is very attractive for international capital. However, when that capital wants to go, so there's lots of international capital that wants to come here, and the government will tell you about all the investors that are coming here and want to come here to make New Zealand productive. But in reality, that's not happening. I've worked very closely on this kind of regime, and we've been ahead of it, in our own kind of company. And what I'm seeing is that there's a bunch of international money that want to have a residential hedge. However, they don't really have an interest in growing the economy. They're interested in this is a personal safety and autonomy, right? I think the problem we face is we are getting a lot of international capital in. I would like to see more of that go to productive, assets and job creation, or just productivity creation. I can move away from the idea of job creation. I do think that lots of jobs are going to be created. I think that plumbers, electricians, builders, they're going to be in high demand, and they're probably going to be able to demand a lot of cash. So they could be in a good space for quite some time. It's the knowledge workers that are in the biggest kind of position of kind of problem. However, they're the best position to reskill and deploy micro businesses.
Especially if they're in business, in the knowledge space. If they're in business, then they'll be the owners of the AI that help accelerate. And they're displacing themselves. I guess it'll be a while longer before the robots come to replace the builders and the plumbers and the candlestick makers, right? And so just trying to understand what the timing is. And going back to the interest rates, if interest rates dropped in New Zealand quite significantly and the rest of the world stayed high, especially the US, then you've got a real problem because of our dollar situation, right?
I mean, are we really saying that 5 to 6% interest rates is abnormal and weird on long-term debt?
Well,
yeah. Let's be real around long-term, the long-term.
Well, this is where I go back. The system, right? Credit is continually expanding, and the amount of debt that government, corporations, and individual households hold, if it's constantly increasing, which it is over time,
which means its currency is decreasing.
Exactly.
Which means that it always drives you back to assets.
Yeah. And the only lever to kind of help alleviate the tension between that is the interest rate. So if money is continually getting cheaper, but you can only fold a bit of paper and have so many times, right? Eventually you hit zero and you can't get off the ground.
You don't want the stretch to be too high where basically the lowest rung of society basically gets punished the most. Because that's when you get revolts. And that's where you get revolutions.
Do you see a situation where that's going to happen? Because I've been talking to a few people lately where they can see that happening from different perspectives. In fact, some people would suggest we're already in that zone where a revolution is brewing. Do you see that happening?
I think that, again, the mimetic cycle, you get a tension point, you get what we call a climax in reflexivity, which is I think it's the 6th or 7th stage, where basically there's an explosion of kind of activity and then a crash, an adrenaline dump of sorts. So yeah, you're going to potentially get some events that happen, climaxes, and then from that, you're going to see a dispersion. I mean, we saw that with the whole, the COVID situation, right? There was a climax, societal mimetic climax, and then a massive adrenaline dump.
Yeah.
And now almost like a complete version away from it, right?
Yep.
So I think it's complex. I don't think that you should lose sleep over it. I think you should try and position it as an opportunity and just think about how you can try and get. And I think the main thing here is governments are not going to say.
Which is a really hard message for some people to hear, right? Because especially over the last 5 years, there's been at least 50% of the population that have looked to the government to save them. And to hear a message, hey, governments aren't going to save us, you really need to protect yourself. And like you say, it kind of comes down to where's resources of income? Can you hedge that? Can you transition towards being an equity owner in some form, right? Can you deploy capital in things that are scarce assets, productive assets? And then, what are some of the other ways that you could protect yourself against that climax of events that could happen, right?
Building your network, building your personal brand, like having a strategy on how you're going to like go and execute, for the next 5 years.
Yeah.
Because that gives you at least a part, like an end goal, like a direction. And I think if you're out of direction, even if it turns out that you didn't execute it quite as well as you wanted, or it didn't turn out, it probably is on average going to end up much better just because you had a direction and you had a strategy.
Yeah.
And you're not trying to get, absolute returns here. This is not necessarily the game of playing. What you're doing is you're trying to, and it's the kind of podcast, right? Ways to Wealth asked you about how you've designed your life so you are actually enjoying your time. And ultimately, all we have on this planet is our time. And I think in the world of AI, where a lot of the content now being created, it's gone too far. You're using AI too much. There's a lot of AI slop around. You're not writing your LinkedIn post. You're basically going into ChatGPT or Gemini and you're getting it written for you.
Yeah, I'm going back to that volatility part of the conversation, right? When things in your world are volatile, uncertain, things are shaking, if you're looking at something constant, you're spotting something into the future, you're going to stay stable. And I've been talking a lot with people at the moment who are probably in a really indecisive state or season in their lives. And the one thing that seems to get people back on the ground is just getting really clear what they want to achieve. Not worrying about how, but what do they want to achieve? Because if they stay focused on that thing, that the how seems to just come around. Yeah, it's amazing. Goal set, right? But let's go back to Eccuity. So I've you've been on my radar now for like over a couple of years since we first connected, and what you're offering in that platform is quite different to just what you would see in a normal trading app or an investment app, platform. And the whole community thing is a big deal. I'm going to another event tonight. Last week I went to 2 different events, and same sort of thing. People want connection. On your way to wealth, how are you solving the connection problem?
We actually just start off with, how do you actually come up with a plan or a strategy for your equity portfolio? And how do you really easily execute it? And, if you look at our technology that we've created and the rails we've created, we've got a savings rate that's up to 3.9, that's at 3.9% in US dollars that's available. So an easy way to basically earn a yield on US dollars. We've got very strong crypto rails with great custodianship through Fireblocks.
Right.
And then we have the ability to, for people to own equities and ETFs in their name. And we do that at 0.4%, per transaction, and up to $2 if you're one of our members. And we also give private members, which is our top membership model, or in the model, $1 million free transacting in US dollars for equities and ETFs each year. Because I had a lot of people when we were interviewing customers being like, oh, if only I stuck to my plan. So we're like, okay, let's build a strategy builder where you can build your own index of equities or a mix of equities, ETFs, and crypto. And it has a specific purpose. Maybe it's a dividend portfolio. Maybe it's a biotech and semiconductor portfolio. Maybe it's, a value portfolio, right? That has a specific purpose. Maybe it's a bond strategy where you've got a bunch of bond ETFs. So you can create these strategies that then allow you to basically invest in them, regularly invest in them. So you might say, well, I want to put in 30% of my cash every fortnight when I get paid into this strategy of equities.
So instead of you just dollar cost averaging into the things and hoping you're getting the numbers right and then having to rebalance,
It does
it all for you.
So we got the crypto stream, we got the equities and ETF stream, and the strategy builder for creating model portfolios very easy. We also have templates on there, and we track like 13F filers like Berkshire Hathaway and others. We will probably do features that will make you trade less, more than we'll make features that make you trade more.
Yeah, good.
Because that's our kind of approach.
Yeah.
But then we got this membership model, and the membership model is interesting because it's giving you unlimited access to independent financial advisors and non-financial experts. So you might need help with a Kiwi saver, or you might need help with exiting your business and you actually would like to just talk to someone and learn about how you would approach maybe a management buyout or something like that. So the membership kind of gives you an AA card for your professional and wealth kind of picture. And we've got some great tools like foreign investment tax tools, crypto tax tools, some net worth tracking and forecasting tools. So you can have all your assets in one place and liabilities, and you can forecast that out. And it's great because it's $1,200 no matter how rich you are.
A year, yeah.
Right?
Who's the ideal?
So the thing we focus on at the moment is we focus on business owners and from a membership perspective. So obviously our platform with the trading, the equities and the crypto, anyone can go there. There's no barrier, and is actually
retail friendly
and significantly more cost effective in many use cases, like compared to your Sharesies or your Easy Cryptos. Okay. And then we've got the membership, and the membership we're aiming at business owners and founders and what we call high agency executives. That are basically people that have chosen the career path, but they're actively looking to diversify and allocate to other areas of their kind of wealth life so that they can get to where they want to get to. And what we get is we get a lot of successful people that go, have I done enough? What is enough? And we help them get a strategy around that kind of outcome.
Yeah.
And we then give them confidence by taking them to, experts like yourself, for example, that know what they're talking about, but aren't actually there to implement. They're there to just provide knowledge.
Yes. Perfect. And I think that's a real cool sweet spot, right? Where you're allowing people to exercise complete autonomy over their own wealth. It is their money. They should be responsible for it. But at the same time, some people aren't really able to take that step on their own. Where do I go? Where do I sign up? How do I figure out which funds to use? There needs to be some sort of guardrails. Like I was talking to somebody yesterday where this was a significant issue for this person. They didn't know how to, or like which form do I sign it was definitely part of the conversation. What's the best for my tax situation given where I'm earning money and how much it is? And based on what we talked about, the types of investments that I should be choosing based on who I am, what funds match that, right? So there needs to be some sort of structure. And I guess
that's where professionals and financial advisors come into play, right?
Yeah.
Because it's about gaining that confidence. And we're not there to say what the right investments are. Like, for example, I've not been, and this, the most bullish person on Bitcoin. But we enable it. We enable the transacting of it because we believe that people should have the freedom to choose how they allocate. But what we will do for you through the membership is we will help you fill up with a strategy so you know where you want. We help you understand where you want to go and what are the potential steps you could take to get.
Okay, so free trial, 14 days.
Yeah.
And there'll be a link that I'll be able to put into the show notes so people can click on.
Yeah.
Perfect. Let's do that.
Awesome.
Awesome, Charlie. Really appreciate the chat. Thanks for coming in today.
Yeah, thanks so much, Jim.
Cheers.
Bye.